If you have $1,000 sitting in your bank account right now, you're quietly losing money, and here's the part most people miss. It feels completely safe while it's happening. In 25 years, the difference between leaving that money in savings versus investing it isn't hundreds of dollars. It's potentially $90,000 you never built. Most people don't avoid investing because they don't have money. They avoid it because they're afraid of doing it wrong. So they wait. And that delay quietly costs them thousands over time. But here's what almost nobody talks about. The cost of waiting isn't just financial. It's psychological. Every year you delay, investing feels harder. The gap feels bigger. The moment never feels right. This video shows you exactly what to do with your first $1,000 in 4 steps. Stay until step 4, because that's where the real wealth actually gets built. The problem isn't access anymore, it's clarity. At around 0.5% in a savings account, your money barely grows. Wait, 0.5%. That's not even beating a parking ticket fine. But inflation, typically around 2 to 3%, slowly erodes purchasing power every year, silently, invisibly, guaranteed. Compare that to the S&P 500, which has returned around 8 to 10% annually over long periods. After inflation, that's closer to 6 to 7% real growth. And that's what actually builds wealth over time. Here's what that gap actually costs in real numbers. A person who leaves $1,000 in a savings account at 0.5% for 30 years ends up with approximately $1,162. The same $1,000 invested in an S&P 500 index fund at 8% annually becomes approximately $10,063. That is not a small difference. That is $8,900 lost to inaction on a single initial investment. The goal here is simple: to turn that $1,000 into the foundation of long-term wealth. 4 clear steps. Let's go. Step 1. Build your foundation. Before you invest a single dollar, there's one step you cannot skip. If you have credit card debt charging 15 to 20% interest, that is your first investment. Paying off that debt gives you a guaranteed return far better than the stock market's long-term average, and without any risk. Think about it. If you invest while carrying high-interest debt, you're losing money faster than your investments can grow. If your debt is above 10%, that's where your first $1,000 should go. Once cleared, the next priority is a small emergency fund. At least $500 to $1,000 in a high-yield savings account. Why does the emergency fund come before investing? Because without it, the first unexpected expense, a car repair, a medical bill, a broken appliance, forces you to sell your investments at whatever price the market is at that moment. If the market is down at that moment, you lock in a loss. The emergency fund is not just financial protection. It is what allows your investments to stay invested through volatility without you being forced to touch them. That's why your emergency fund acts as a buffer between your life and your investments. And once that buffer is in place, step 2 opens up an account type that most beginners completely overlook. Step 2, open the right account. In the US, beginner-friendly platforms include Fidelity, Charles Schwab, and Vanguard, all offering 0 commissions and fractional shares. For retirement, a Roth IRA is powerful because your money grows completely tax-free. Here's what that means in numbers. If your $1,000 grows to $100,000 over 30 years, in a regular brokerage account, you could owe $20,000 or more in taxes on that gain. In a Roth IRA, you pay 0. That's $20,000 extra, just from choosing the right account type. In Canada, you have TFSA or RRSP accounts, the same tax-sheltered principle. Most people think investing is about picking the right platform. It's not. The best platform is simply the one that gets you started. Here is how to open one today. For the US, go to fidelity.com or schwab.com. Both are free, require no minimum balance to open, and the entire setup takes under 15 minutes with just your name, address, social security number, and a linked bank account. For Canada, go to wealthsimple.com, same process, same time, and the platform guides you step by step. You do not need to understand everything before you open the account. Opening it is the decision. Learning happens after. The account is the easy part. What you put inside it, that's where most people get it completely backwards. Step 3 is where this gets interesting. Step 3. Invest in the right assets. For your first $1,000, start with a broad market index fund. In 1976, John Bogle created the first index fund for ordinary investors, and Warren Buffett told his own trustees to put 90% of his wife's inheritance into a simple S&P 500 index fund. Not hedge funds, not individual stocks. In the US, FXAIX, SWPPX, or VOO, all tracking 500 of the largest US companies. In Canada, Wealthsimple and TDE Series offer equivalent low-cost index funds. If you're outside North America, search for a low-cost index fund on your local platform. In 2008, markets dropped over 50%. In 2020, they fell over 30% in weeks. This is part of the process. Volatility is the price you pay for long-term growth. The investors who stayed the course during those crashes came out wealthier. The ones who panicked sold, locked in losses they never recovered. Another major advantage: many index funds charge less than 0.05% per year versus traditional advisors charging around 1%. Over decades, that difference runs into tens of thousands of dollars. Here is what that cost difference looks like in practice. On a $50,000 portfolio over 30 years at 8% annual return, a 0.05% expense ratio costs you approximately $900 in total fees. The same portfolio with a 1% fee costs you approximately $28,000 in total fees. The fund with the 1% fee would need to outperform the index by 0.95% every single year just to break even. According to S&P's SPYVA scorecard, over a 15-year period, the majority of active fund managers fail to do exactly that. Step 4. Automate and stay consistent. The final step is what actually builds wealth: consistency. Set up automatic investing, weekly, bi-weekly, or monthly. Think of it like paying your phone bill. It happens without you making a decision every time. This transforms investing from a deliberate choice into a background process. This is dollar cost averaging. Instead of investing everything at once, you invest gradually. If you invest $100 at a time, only your first $100 bought at the peak. Your next $900 buys shares at cheaper prices. You're not watching your money disappear. You're getting a discount. The DALBAR report shows that investors consistently underperform the market, not because of bad investments, but because of emotional decisions. Fear during downturns, greed during rallies, panic during uncertainty. These behaviors cause people to buy high and sell low. The Charles Schwab Perfect Timing Study ran a real-world comparison over a 20-year period. It compared 5 investors: one who invested perfectly at every market low, one who invested on the first day of every year regardless of price, one who spread investments evenly across each year, one who invested at every market peak, the worst possible timing, and one who stayed in cash waiting for the right moment. The results? Perfect timing produced $87,004. First day of year investing produced $81,650. Dollar cost averaging produced $79,510. Worst possible timing produced $72,487. Cash, $51,291. The person who waited produced the worst outcome, by far. Consistency beat inaction every time, including when the timing was perfect. Here is the real outcome. If you invest $1,000 and earn around 8 to 10% annually, after 25 years, that same $1,000 could grow to around $10,000. Now add just $100 per month. After 25 years, you could have around $120,000 to $140,000. Pause on that number. Out of that total, you contributed only around $31,000. The remaining $90,000 to $100,000 came from compounding, not from working harder, not from taking more risk, just from time. That is the real power of investing. Not effort, but time. Subscribe and tell us in the comments, what's been stopping you from starting? Let's talk about it. The tools are available. The strategy is simple. The information is right here. The only variable left is you. Every day you wait, the gap grows. Not because the market changed, not because you weren't ready, because time moved, and you didn't. That ends today. Will you start?